So the profitability ratios are percentages. They are percentages using the income statement mostly. So we have the gross profit margin, the net profit margin, the operating profit margin, and the return on investment. So for the gross profit margin, we need to identify it is the margin of profits that are left over for other expenses aside from the cost of goods sold. So kailangan nating i-factor kung ano yung gross expenses natin, yung gross expenses. So parang ito yung pinakapuhunan for that specific set. So we need to identify the net sales and the cost of goods sold. So a higher gross profit margin means that the company has more cash to pay for expenses. So that means kapag mas maliit yung naging value ng cost of goods sold natin, mas malaki yung chance na magkaroon tayo ng higher net profits, or since malaki magiging allocation nung cash natin or nung sales natin for all of our other expenses, that gives us better prospects na mas meron tayong na mas malaki yung value na makukuha natin for our net income. So for example, first let's identify the net sales. In this case, it is just sales 119,000. Then we identify the cost of goods sold, which is 33,844. Then we divide the difference. We compute for the difference. So 119,000 minus 33,844. We have 85,156. So that means 85,156. That is the value that we have left over for all of our other expenses. So 85,156 is what comprises of salaries up until net income. So from salaries to net income is 85,156. That is the allocation. Next, we divide the difference of sales and cost of goods sold. The gross profits is 85,156 divided by sales. So 119,000. So 85,156 divided by 119,000 is 0.72. Then we multiply the quotient by 100 to get its percentage, and we have 72%. So let's repeat the process. We first identify our net sales. Then we need to deduct we identify also the cost of goods sold. We need to get their difference. That is step number 3. Then we use the difference and the sales. So we use that to get the gross profit margin, and then we convert it into the percentage. Try solving for this. Just disregard the misplaced commas. Okay, let's identify first our sales account. How much is our sales account? The sales account
5 million po.
Yes, the sales account is 5 million. And then how much is our cost of goods sold?
2,500,000.
Okay, 2,500,000. So we get the gross profit, which is 2,500,000. We divide that with our gross sales, which is 5 million. So 2.5 million divided by 5 million is equal to 0.5 and 0.50 times 100 is 50%. Next, we go with the net profit margin. The net profit margin is essentially just the vertical analysis for the net income. So we have the net income divided by the gross revenue. So if we have a higher net profit margin, that means we are more efficient in generating profits. So malaki yung napupunta na allocation for our net income. Therefore, we have little to no expenses because we're going to judge this based on the percentage. So for example, remember that this is just the vertical analysis, but we call it for the net profit margin. Vertical analysis for the net income. So step one, we identify the net income. So if it's not generated, kung ang binigay sa inyo is just a trial balance, you can get you must generate first the net income by deducting all of the expenses to the sales account. So in this case, we have the net income, and that is 37,709. Our sales account is 119,000. So 37,709 divided by 119,000 times 100 is 32%. So as I've said, it's just vertical analysis of the net income or the net profits. So we'll be using the same example as before. Compute for the net income, the net profit margin of this one.
8.45 po.
Okay, 8.45% or 8%. Net income is 422,500 divided by 5 million, so we have 8%. Second to last is the operating profit margin. The operating profit margin shows the proportion of the profit that would cover the non-operating costs, and this would mean your interest expenses and income taxes. So the formula is operating earnings divided by revenue. So we get the value of the operating earnings. This is or the earnings before interest and taxes by getting our net income. Net income, and if there are interest and income taxes that are factored getting the net income, those values has to be reversed. Therefore, kapag meron tayong value dun sa income statement natin na income tax or interest expense, and yung income tax natin is already the net income is already generated, kailangan nating idagdag ulit yung income taxes natin and interest expense doon sa net income para makuha natin yung operating earnings or the earnings before interest and taxes. So for example, first step is to identify the gross sales or the gross revenue, which is 119,000. Next, we identify the operating earnings. If there are income taxes that were paid and was factored into the computation of the net income, it has to be reversed. In this case, meron tayong 15,447 na income tax expense. So ipag-add natin yung net income and yung 15,447 para ma-reverse siya. And our operating earnings or earnings before interest or taxes is 53,156. Next, we get the relationship of this value with our gross sales. So 53,156 divided by 119,000 times 100 is equal to 45%. So this means after our operating earnings, we still have 45% of the profits of the gross profits to use for our income taxes and for the interest expenses. Okay, so try solving for this income statement. Net income, Ms. Libunao is correct. 13% is our operating profit margin. So we identify the net income, which is 422,500, and then since this net income has an income tax factored into it, which is 227,500, we need to factor that. We need to reverse that value. So 422,500 plus 227,500 is equal to 650,000. 650,000 divided by 5 million is equal to 0.13 times 100, and we have 13%. Last one is return on investment. So return on investment measures the efficiency of our investment to our yield or to our returns. It is computed by getting the net income and dividing it with the initial capital. So the concerned accounts in here is the net income first, and then we have the capital accounts. So if if you just if the direction is for you to just use the capital account, then you use the capital account. If it's not indicated that you need to use the fixed assets or the long-term liability, don't use them, then just use the relevance of the net income to the initial capital. So net income divided by initial capital is our formula. So let's apply it here. First, we identify the capital, and we will use that as our initial capital, the value for the initial capital. So in this case, we have 300,000. Then we identify the net income. So kunin natin 119,000 minus all of these expenses. And we have 37,709. So we would use that as to divide the net to divide with the capital. So 37,709 divided by 300,000 is equal to 13% net profit margin. So this means for that specific period, dun sa period na yun, dun sa kung ano ba 2019. For 2019, we have a 13% return on investment. So 13% ng 300,000 nakuha natin as a net profit. Okay, so try solving for this one. Use the capital stock as the value of the capital. Okay, Maria Fatima Andrade, 36% is correct. So our net income is 12,000 minus 2,000 minus 1,000 is equal to 9,000. So 9,000 of net income divided by our capital of 25,000 is equal to 36%.